Welcome to another deep dive brought to you by 10 Leaves.
Great to be here.
Today, we're taking the express elevator up into the world of global finance. We're going to unpack the Abu Dhabi Global Market, or ADGM. And our mission really is to give you a comprehensive look at how this whole ecosystem works, with a laser focus on the Category 3C Asset Manager license.
Which is really the key entry point, for independent wealth managers, institutional funds.
And this is so timely, because what's happening in ADGM isn't just, typical market growth. This is something else.
Oh, it's exponential. It's an acceleration. We're tracking a financial center that already hosts, over 130 managers and 160 funds.
Why?
And the recent numbers on assets under management, the AUM, that shows growth spiking by over 200%.
200%. I mean, that statistic alone, it just demands attention, doesn't it?
It really does.
It confirms ADGM's position as the largest and, critically, the fastest-growing financial center in the entire MENA region by active licenses. So, for global fund managers listening, what's the single biggest factor drawing this kind of attention?
I think it really boils down to two things: trust and familiarity. Unlike a lot of the surrounding region, the ADGM operates under an advanced common law system. So we're talking about an independent, English-speaking judicial system.
And that's entirely separate from the mainland UAE civil law structure.
Entirely separate. And for global asset managers, especially those from North America or Europe or parts of Asia, common law gives them predictability. It gives them precedent.
Right, robustness in contract.
Exactly. This is the bedrock that lets them move billions of dollars with real confidence.
That legal certainty is massive. But let's look beyond the courtroom for a second and focus on the strategic positioning. I mean, why are firms moving now?
Well, the raw numbers are just...
Sure.
They're compelling, you said it. 154 fund and asset managers, 209 funds as of mid-2025. AUM growth of about 42% year over year.
So what access does ADGM provide that, say, other competing hubs don't?
It's unparalleled access to capital and unparalleled geographic leverage.
Okay, let's break that down. Capital first.
On the capital side, you're situated right next to the massive dynamic sovereign wealth funds of Abu Dhabi. That opens doors to regional institutional flows that are they're essential for any large-scale fund.
And geographically, I mean, you look at a map and you're really at a true global nexus.
Precisely. You have to remember that the Middle East, Africa, and South Asia Masa, that region is rapidly becoming the true center of gravity for the global economy. And the UAE specifically, it plays this pivotal role in facilitating high-growth South-South trade. So connecting capital from places like China and India into emerging markets all across Africa.
So if your fund's strategy involves accessing that capital or deploying it into those high-growth corridors,
then ADGM is strategically perfectly located right at the midpoint.
beyond the geography and the capital flows, what about the operational sweeteners, the things that make relocation genuinely worthwhile for the firm itself? Because setting up shop globally it's expensive.
It is. But ADGM has systematically removed barriers to entry that you see in other jurisdictions.
For instance,
You get the benefit of 100% foreign ownership of your entity. No local partners required. No restrictions on repatriating capital or using foreign talent.
and the tax framework is a big one.
It's exceptionally clear. Zero tax on employee income and a confirmed 0% corporate tax rate, provided you meet certain qualifications, of course.
So when you combine that legal certainty with the fiscal efficiency and operational freedom, it's a pretty compelling package.
It becomes a very difficult proposition to ignore.
It also seems like ADGM has prioritized attracting talent, not just balance sheets. The sources mention the ecosystem, the vibrant business district, places like the Galleria Mall.
Yeah, the lifestyle element.
Right. It suggests they're pitching a place where highly experienced people actually want to live and work.
And that's a crucial insight. They recognize that if you're going to draw senior investment talent, someone with, 15 years of experience managing portfolios, they need an environment that supports a high quality of life for them and for their family.
So it's not just a box-checking exercise.
Not at all. It's a fully functional, sophisticated community that reinforces the financial ecosystem.
Okay, let's transition to the core mechanism here. The Category 3C license. So if a firm or an independent investment banker is looking to set up discretionary portfolio management in ADGM, this is the license they need. What's the scope of activity? What does it let you do?
The Cat 3C license is really the workhorse for asset managers. It enables that discretionary portfolio management, and it covers 3 primary regulated activities. firms can sort of tailor these to their business plan.
Okay, so let's start with the cornerstone activity.
That would be managing assets. This is your standard discretionary model. The manager gets explicit authority from the client to make investment decisions, buying, selling, holding all within a defined mandate.
Okay, so that's full portfolio control based on the client agreement. What if the firm wants to provide strategic advice, but without actually taking over the management function?
Right, so that falls under the second regulated activity, advising on investments or credit. This is crucial for wealth managers.
How so?
It involves providing specific guidance, recommendations on whether a client should enter into a transaction, exit one, or modify it.
So buying a security or even entering a credit facility.
Exactly. The key regulatory line here is that you have to be offering an opinion or guidance. Just, providing market data or facts doesn't require this license.
And the third activity, the facilitation role.
That is arranging deals and investments or arranging credit. Think of this as the intermediary function.
Like a connector.
Precisely. You're facilitating a transaction by, say, introducing parties, negotiating terms, or processing instructions that lead to a deal. But the regulatory distinction is vital here.
Which is?
An arranger is purely facilitating. They do not have the legal authority to bind the parties to the contract. That's what separates them from licensed brokers or dealers who act as agents.
It's a powerful combination: management, advisory, and arranging. I'm wondering, what kind of trend does this particular license combination really support? I keep hearing about external asset managers, or EAMs.
You've hit it exactly. The EAM trend is where Cat 3C shines. We're seeing this major shift where seasoned investment bankers, portfolio managers, they're leaving the big institutions, the bulge bracket firms.
Yeah, setting up their own shops.
Exactly. They establish their own independent advisory and management firms. They take their client book with them, often targeting high net worth or ultra high net worth clients in the Gulf. The Cat 3C is perfectly suited for this independent model.
All right, let's move to the nuts and bolts of setting up. We have the license scope. Now let's get into the capital and staffing. We know the base capital for a Cat 3C is, what, $250,000 US, but I hear firms often need much more. How complicated is the actual capital requirement?
It is nuanced, and, the complexity is really designed to ensure stability. That $250,000 is the minimum base capital. But the Financial Services Regulatory Authority, the FSRA, requires the firm to hold the highest amount from 3 different calculations: base capital, risk-based capital, and the expense-based capital minimum, or EBCM.
And that EBCM often drives the final number, right?
It often does.
Can you break that down for us? The EBCM calculation sounds like it's based on an internal expense forecast.
It is, and this is actually where firms can optimize their setup. The EBCM is designed to make sure the firm can weather operational downtime, so it usually covers a period of 13 to 18 weeks of your average annual expenditure.
Wait, 13 to 18 weeks? That distinction seems massive. Why the range?
It's absolutely critical. So if your firm holds client assets, meaning you manage the custodial accounts, physically settle trades, the EBCM is calculated as 18 over 52 of your annual expenditure.
Okay, 18 weeks.
But if your firm merely controls client assets and relies on a licensed custodian to actually hold those assets, the calculation drops significantly.
To what?
To 13 over 52 of annual expenditure. This regulatory distinction heavily favors firms using established institutional custodians. It reduces the initial capital pressure, improves cash flow.
That's a key business decision right there from the outset. Now, on the operational side, physical presence is mandatory, correct? Do I have to commit to a traditional long-term lease?
So you're rigid on location but flexible on configuration.
Okay.
Yes, every regulated entity must lease a closed office space either on Almarai Island or Al Reem Island. The FSRA needs to know you are truly established in the ADGM.
So where does the flexibility come in?
It's in the lease type. Instead of demanding a multi-year, multi-million-dollar commitment, the ADGM accepts modern, flexible, serviced office options.
Like a WeWork or something similar.
Exactly. You can use providers like WeWork at Hub 71 or Cloud Spaces. These often offer packages that satisfy that mandatory closed office rule with modest monthly fees. Much, much lower than a traditional lease, which usually starts from around $10,000 US a year.
That makes the barrier to entry significantly more manageable for a startup EAM.
Okay, let's talk staffing. The FSRA requires several mandatory senior roles. Is it realistic for a small, specialized manager to hire all those experienced people right away?
It's a heavy lift. The FSRA requires a robust governance structure. That means mandatory appointments. Board of directors, a senior executive officer or SEO, a finance officer, risk officer, a compliance officer, and a money laundering reporting officer, the MLRO, plus auditors.
And the SEO and the compliance officer, they need to be ordinarily resident in the UAE and have significant experience. We're talking 10 to 15 years for the SEO. That salary commitment is substantial.
It is.
So there's a paradox here. ADGM demands this high level of expertise, yet allows for flexibility in how those roles are filled. That's it. The sophistication lies in the outsourcing advantage. The FSRA requires the accountability and the function, but it recognizes that a startup manager might not need a full-time in-house risk officer from day one.
So you can outsource some of these roles.
A lot of them. The finance officer, the risk officer, the compliance officer, the MLRO, and the internal auditor roles can all be outsourced to a competent, licensed service provider.
And that's often the most efficient way to do it.
It's the most economical and efficient way to meet the standards while focusing your limited high salary budget on the SEO and the portfolio managers themselves.
So a manager has their capital strategy, their outsourcing plan is ready. What does the regulatory roadmap actually look like? What are the key stages from just expressing interest to getting that final authorization?
Well, the process usually starts with pre-application meetings, some formal introductions, just making sure the FSRA is aligned with your proposed business model from the get-go. This immediately leads to the most critical document, the Regulatory Business Plan, or RBP. That's done alongside comprehensive financial projections.
And given the high fees we're about to discuss, that RBP sounds like it's the single most important document in the entire process.
It absolutely is. It's the blueprint the regulator uses to judge your competence, your resource allocation, your viability, everything. It has to be watertight.
And once the firm is ready with that, what's next?
The formal application gets submitted via their online portal.
And the review clock starts ticking then. How long does the FSRA typically take?
Generally, the formal review period is about 60 to 90 days. During this time, the regulator does deep due diligence. They often do highly detailed interviews with the designated SEO, the finance officer, the compliance, and MLRO.
So it's not a rubber stamp. They're really testing the people in the plan.
Not at all. They're testing the competence of the individuals and the robustness of that RBP.
And assuming that goes well, they issue an in-principle approval, an IPA. What happens between the IPA and the final permission?
The IPA basically acts as a checklist. The applicant has to satisfy the conditions set out by the FSRA,
Leans life.
finalizing the legal structure, opening the company bank account, depositing the mandatory share capital, and securing professional indemnity insurance, which is a required, non-negotiable expense.
And once all those boxes are ticked,
Once those conditions are met and verified, the final financial service permissions are issued.
let's talk about those fees that make a perfect RBP so necessary. What are the concrete costs involved in this?
So you have two main bodies charging fees. The FSRA, on the regulatory side, charges a one-time application fee of $25,000 for the principal activity, managing assets.
Okay.
If, as is typical, you add advising and arranging, you add another $10,000 for each of those. And critically, the annual license fee is structured exactly the same way.
So a firm applying for all three key activities is looking at $45,000 to apply, and then $45,000 annually just for the FSRA permission.
That's correct.
Yeah.
And if your RBP is rejected or has significant flaws, that initial application fee is non-refundable.
That's a huge sunk cost.
It is, and that's why professional RBP preparation is really non-negotiable. Separately, you have the registration authority. They handle the corporate structure. They charge an annual business activity fee of $16,000.
Plus some smaller one-off fees, I imagine.
Yep, smaller one-time incorporation fees and an annual $300 data protection renewal. It all needs to be budgeted for accurately before you even start.
Once that authorization is secured, let's talk operational scope. We established the ADGM as a regional hub, but how far does that reach extend in practice? Can an ADGM firm genuinely operate across the whole UAE?
Absolutely, and this is one of the most significant selling points. ADGM licensed firms can service clients across the wider UAE, Dubai, Sharjah, wherever, and internationally.
So what's the rule?
The rule is that the regulated activity must be conducted in or from ADGM. This allows an ADGM-based manager to market their services and onboard clients anywhere in the UAE without needing a separate, costly onshore license.
That sounds perfect for regional coverage.
Yeah.
But what's the practical compliance challenge of maintaining core operations in or from ADGM when your clients might be scattered all over?
That is the crucial operational challenge. It means governance, compliance monitoring, client file management, decision-making. all of it must be demonstrably anchored in that ADGM office.
Which is why that robust outsourced compliance and risk function becomes so essential.
Exactly. You need experts who understand that subtle difference between an onshore action and an ADGM action to ensure you're always in compliance.
That takes us right back to the support services available. For a new independent manager, what kind of end-to-end assistance is available in the ecosystem?
The support ecosystem in ADGM is now highly sophisticated. It starts with pre-licensing assistance, preparing that critical RBP, providing outsourced CO, FO, and risk officer nominees, helping structure the legal entity.
And what about the ongoing day-to-day administrative burdens that can distract managers from, focusing on client portfolios?
Post-licensing support handles all of that. Continuous outsourced compliance, accounting, risk support, along with more specialized corporate tax and VAT reporting.
And for startups specifically?
For startups, support often extends to securing those foundational legal documents like founder agreements, shareholder agreements, even structuring employee stock option plans or ESOPs. The goal is to provide a turnkey solution so managers can focus solely on managing assets.
This has been incredibly insightful.
If we condense this whole deep dive into the ADGM Category 3C license, I think 3 key takeaways should really stick with you.
Go for it.
First, the strategic shift toward that common law framework. It offers the stability global institutional managers demand. Second, the capital structure is designed for efficiency, highlighted by that EBCM distinction that rewards firms who use custodians.
Oh, and the third.
And finally, given those high upfront fixed application costs, the quality of your regulatory business plan is the single most critical factor in a successful, timely launch.
It's clear that Abu Dhabi has designed a competitive powerhouse aimed squarely at attracting independent, high-caliber talent and institutional capital. The flow of funds and managers is already reshaping the regional landscape. So here's a final thought for you to consider. Given ADGM's keen focus on rapidly adopting fintech and digital asset regulation alongside this aggressive asset management growth, how will this platform continue to shift the balance of financial power toward the rapidly expanding trillion-dollar economies of the massive region over the next decade?
A fascinating trajectory to watch unfold.
Indeed. Thank you for joining us for this deep dive. This discussion is brought to you by 10 Leaves.